Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going back to covered calls, but the thing that I want to focus on today is what can happen from the time we enter the trade until expiration. We're going to be talking about 5 things a trader really should understand and maybe pay attention to as that trade makes its way toward expiration. Should be a really interesting discussion. Before we can get to that, though, let me first of all say hello to everybody out there in YouTube. Great to see so many familiar names out there. Hello there, George and JB52, Will, Scott, Ricebird, Eva, Josh, David, Lawrence, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. I also want to welcome anybody that might be here for the very first time. Great to have you on board. And if you're watching on the YouTube archive after the fact, after the webcast has been concluded, if you're just watching the recording, enjoy the show, but be aware that you're invited to join us in the live presentation if you'd like to be here. This is a Monday webcast series. We always kick things off promptly at 2 Eastern. We'd love to have you here in the live stream audience. And I also want to let our live stream audience know that my very good friend Brent Moores is going to be hanging out in the chats. Brent's going to be addressing any questions that I can't get to just during the flow of the presentation. Brent's a fabulous presenter himself, brings a lot of knowledge and experience to this discussion. Thanks for having my back there, Brent. And also, I do want to let you know that I'm going to be making aware of some other resources that are available to you outside of this webcast, including, if you're not doing this already, make sure that you're following me and Brent on X. You can follow Brent there. If you have that X account, follow Brent at Brent Moores CS. You can follow me on X at Cameron May CS. But let's get into this discussion of covered calls and managing those positions. 5 key things that a trader might want to keep an eye on as they're making their way toward expiration. But first thing that we always need to do is consider the risks associated with investing. These risks are real. Please bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set an agenda for what we're going to be covering today. Now, in this webcast series, we place and manage a set of example trades in an example paper money portfolio. So the first thing that we're going to be doing is having a look at our 5 current positions. Now, these are covered calls and short puts, bullish strategies. Yep, they're struggling in this quite bearish market. So we'll see what might need to be done with the existing positions. Then we'll take a quick peek at what's going on with the S&P 500 and set the stage for this discussion of managing covered call trades. So to do that, after we have a look at the markets, we're going to place an example new covered call, and we want to talk about what may transpire from today through the expiration of the contract that we select, and talk about 5 important things that the trader might want to keep an eye on that journey. So let's see. Garit's asking, could the administration wanting to fire Jerome Powell have anything to do with stock price? Certainly could play a role, right? Lots of variables in what sets stock prices across a spectrum of potential influences. That's one. But let's go have a look and see what's going on with our example paper money portfolio. We have 5 positions right now: Apple, IBM, Meta, Tesla, and Wells Fargo. So we're going to start with Apple. We have a covered call position here. The preference when we sell a 230 call is that we'd like the stock to go up, helping the ownership of the stock, but hopefully allowing that 230 call to expire worthless. Well, the stock is below the 230 strike, so that's good, but actually going a little bit too far down. That's pretty common in today's markets. So let's go have a look at this Apple position. And actually, this Apple position started out as what we call the wheel strategy. We sold a put, so it all started right back here. Sold the 21st of March, 235 put. That contract was ultimately assigned. We realized a $3 profit on the expired put, but we were assigned the shares at 235, so that had an initial break even at 232. Then we sold a 17th of April 235 call and closed that out for an 80-cent profit, so that lowered our break even from 232 down to 231.20. Now, most recently, we last week sold a 16th of May 230 call against that stock position. Now, be aware, if we sell a call at 230 and we were put the shares at 235, what we've then agreed to do is to sell the shares for less than what we paid them for. But along the way, if we've collected a sufficient amount of premium, we may still break even on this trade. That's if things worked out perfectly. They're not working out perfectly right now. You can see the stock has really taken a jump downward. So our break even, we're quite some distance below that. A trader, an owner of shares who was trading technically may have decided to exit this position entirely. We're still in the position though. But with this so far below this 230 call strike, I'll bet we could close this out for pennies on the dollar versus the $1.88 that was originally received. Let's go see what this is trading for. It is trading, we collected 188. It's worth 39 cents. If we close this right now, that would mean that we're capturing, assuming we're able to get a fill at or near current prices, we'd be capturing about 80% of the original maximum profit on just the call portion. And I think that's what we're going to be doing today, because there's another consideration here. Look on our charts. What do we have coming up right around the corner? Right out there on the 1st is an earnings announcement. Now, let's see, what is that? What is the 1st? Somebody tell me. Anyway, I have to let you know, I'm actually heading out on vacation at the end of this week, so I'm not going to be here to talk about this announcement after this. So I'm going to close up this trade, but I'm going to retain the share position. We're going to see how that does over earnings. There's obviously risk in doing that. I'm not going to be selling a new call, so we're not going to be putting a cap should that earnings go well. The stock will be unencumbered by an obligation to maybe have to sell it at a specific price above the current price. But we'll see how that goes. Now, Anoop says short put verticals. Yeah, we don't do any short put verticals in this webcast, Anoop, but yeah, you're right. Actually, no, sorry. You asked the question, short put verticals means a bear put spread. That would actually be a bullish put spread. But in any case, let's go close up this call portion of this trade. And to close this out, we right click on the call and create a closing order to buy that call back. There we go. Let's buy it back. Looks like it might cost us about 40 cents. I'll leave it right there. We'll see if we can get a fill here. When we submit a limit order, there's a risk the order might not fill, but let's try to do this for 40 cents. It would be almost 80% of the original credit realized as a gain if we can get out for 40 cents. There would be a commission if this fills of 65 cents, bringing the total cost to exit $40.65. And let's send that off. And okay, we close that at 39 cents. Great. All right, so what does that realize for a profit here? That would be a buck, almost a buck 50, $1.49. Let's edit this. So we have a $1.49 profit. There we go. Let's change the color of that font. This just indicates that we're done with that trade. And I'll even edit this trend line. That's not the one that I wanted. Let's do the red one. Change that to pink. There we go. Just indicating that we're done with that position. So all we have now is a long stock trade. We'll see how that goes. Next up is our IBM position, another covered call. We sold the 260 strike for the 16th of May. That still has 25 days left till expiration. We're solidly below 260, so not much of a threat that we could get assigned early. It still could happen. That's still a possibility, but that's pretty far out of the money. Here is the history of our IBM trade. So with IBM, we bought shares at 249.05. Along the way, realized a gain on one call of 203, realized another gain of on another call of 268. Last week, we sold the 16th of May 260 call. That's right here for 355. That's lowered our break even to 240, and we're a little bit below that. But this is a good example of how, if we were to compare this position, right now it's unprofitable. But if we were to compare that to, let's say, a stock position where we just bought the shares at 249 and now they're $16 underwater, these premiums are helping to reduce that impact. This shows you how it's not a true hedge, but selling calls can be a bit of a buffer against loss, as long as the loss isn't too large. But for this one, we're going to let this continue to work, still 25 days. If we get a bit of a rally, we can get right back up above that break even. We'll see. Meta, we've sold a put. This one's looking likely to be assigned. It's not guaranteed yet, though. We've just 4 days till expiration. I will say, in paper money, early assignment is not a thing. That's one way that there is a distinction between practice trading and real trading. Nobody's assigning practice trades early. So in this case, we sold the 510 put. Let's look at that on our chart. So with Meta, this was the date of entry. Sold the 510 put at the time. It just felt like, oh, sure, yeah, we're going to be up here where we need this to be, but we got a quick drop. And then the stock has actually been bouncing around that break even. It's been above and below our strike. Right now, we're below that. So that is now an in the money put. That elevates risk of assignment. I want to talk about that some more with our 5 things to keep an eye on when we're in a short contract. But with paper money, I do have the luxury of just saying, well, let's just see if we can recover. But in real money, this could be and would be at an elevated risk of early assignment. Does not mean it absolutely will be assigned early. It's just that it's more likely than it would be if it were, let's say, out of the money or if there were more time till expiration. This one, I'm going to let it go. You can see here with the volatility of the stock, it really would only take a day or two if we could get a bounce proportionate to the moves that we've seen recently to get back up above break even and maybe put this thing right back out of the money, get back up above 510. Now, we also have Tesla. Tesla was a covered call position. Right now, we just own the stock because we bought 100 shares. We sold a call that expired here on April 18th. That thing has expired. That 280 call expired, 249 profit. But we've dropped back down below what we paid for the stock. And we'll see, where are we now? Right now, we're at 224. So yeah, underwater on the stock. We did have the 249 realized gain on the call, so still losing money net. But with that earnings announcement right around the corner, I'm not going to sell another call. Some people would. There can be pros and cons to selling calls right before earnings. A potential pro is that the premiums tend to be much higher than at other times for the same time frame of a contract. So that's a potential pro. The potential con is that we'd be limiting the upside right before a big, potentially important event that could spike the stock shares and potentially benefit these 100 shares that we own. So I'm going to leave that one alone. And finally, we have Wells Fargo, own 100 shares, sold the 67.5 calls. Now this is part of, let me bring that up. This is part of a series of positions that we have had over the last several months. Purchase price of $70. We sold a call up here, which realized a 165 profit. It just expired. Then we sold another call at the 72.5 level, $1.22. That one we've closed out, and we sold a 16th of May 67.5 call. So we have a couple of realized gains to set against now an unrealized loss. You see the share price down here at 63.5. That feels kind of nice to have about $3 in realized gains to chip into that loss. Now we sold this 67.5 call for $1.23. That's brought our break even all the way down to 65.90. We just need to get a little bit of reversal here, get back up above 65.90. And clearly this is it's not a perfect scenario, but it's maybe better than somebody just bought the shares at 70 and watched them decay down to 63.5. So with this one, I'm going to let this trade continue to work. This is a pretty fresh trade. I don't think it's gone down much in value. No, we sold it for $1.23. It's worth $1.09. That's because from where we sold it to where we are right now, it hasn't really done much. So we'll just let that trade continue to work. So those are our 5 existing positions. Let's go see what's going on with the markets. I won't spend much time on that. I want to spend a little bit more time talking through 5 things that a trader might want to pay attention to when they're in a covered call, waiting, hopefully pushing toward expiration. But here's the S&P 500. And here's what traders have been seeing for, it's not fun to look at for the benefit, for the sake of our, let's say, our 401ks, those sorts of things, the bulls out there. Not having a lot of fun, and that continues today. It's down 3.3% on the day. Interestingly, though, Eva, I saw your comment in chat. I want to go back to that, Eva. Let's see. Eva said something about, where was that? Been doing a little on-sale buying today. Got to keep a stiff upper lip, as the Brits say. I think some people are definitely taking that position. Now, whether that turns out to be the right thing or not, time will tell. But here's what's been going on. Sold off 10.5%, got a nice bounce up. This turned out to be what some might call a dead cat bounce. That's just a kind of a, in my opinion, overly graphic description of some bargain shopping in an otherwise bearish market environment. And the projection might be there that stocks represented here by the S&P 500 might continue to sell off, and that's just what we've done. Sold off and touched down into bear market territory. But interestingly, on this first rebound, we are bouncing right against this trend line. On these more recent lows, we're just bouncing against a lower trend line. You can see that on a 3-year chart. So we'll see if this trend line actually holds. But we rebounded upward, came up against previous support, maybe acting as new resistance. And also this previous support, we've talked about how that is right at the 50% level between this high and that low. If we want to draw that fib back on there, we can see that. Let's go down to this low, move up to the high, and you can see there's that 50%. We really came right up to that, and then we started selling off from here again. Dave says, where is the bottom, Dave? The natural question to a chartist. They may think there's actually some evidence here that we're relatively close already. That is this second trend line. We've already touched all the way down into bear market territory, and this second trend line has already at least given us some signs of hope that might be a support. I like to say, yeah, time will tell, but I think I wouldn't be alone in making an observation that maybe some are looking at that level. So could we go down a bit further? Yeah. If we hold and start to rally there, could some start to assign some greater technical significance to that as a potential floor? Yep. And actually, with that in mind, I'm going to use that to set the stage for today's trade. Let's say that we're in that group of traders that thinks that stocks are on sale. And so maybe they want to look out, maybe find something that's taken some lumps recently, but possibly maybe showing a little bit more strength than elsewhere in the markets. And then we're going to sell a covered call against that position. So here's going to be our example trade today. Let's go have a look at Abbott Labs. So yeah, Abbott hit a peak. It pulled down to lows. It was making lower highs and lower lows. But more recently, it's been spurred a little bit higher. Just got clear of earnings. That's another thing that traders have to kind of contend with at the moment. If we don't like earnings, we might need to check the calendar and see which companies have already had earnings. But this earnings was comparatively well received. Actually popped all the way up to previous highs. Now we've surrendered some of those gains, but it's kind of interesting. Let's zoom in here, and let's plan a trade out here. Actually, as I zoom in, let me do this. I don't need to go all the way out here anymore. I just had this extra space so that we could revisit the history of some of my current positions. But let's plan another trade for May 16th. So we're not going to have to see all this white space. Let me just change this. Let's change our right expansion setting to just like, let's see if 23 days will get it done. Yep, that'll work. I could even cut it down to maybe 21. There we go. Just sort of spreads out that chart, allows us a little bit closer view. But now with that done, I'm going to zoom back in on these last few weeks, and you can see here that there was a price ceiling right here all the way from March 14th until a heavy breakout on March 27th. So 2 weeks where prices hovered below that 128.5 level. Another big day breaking us back down below that, and it acted as resistance again. But kind of interesting, maybe some technical traders might note we've popped up above that. And even with this sell-off today, today's low coming right down to about 128. What was the low? 128.51. Yeah. So let's say that our technical trader sees, well, here's a stock that seems to be holding up a little bit better than most out there. It's surrendered some recent gains after an earnings announcement, but at least we're clear of that event, and we've come down to a potential support. So yeah, Eva says we're going to be doing a buy right, exactly right. We're going to be buying the stock and then writing a contract, in other words, doing a covered call. So let's do this. Let's go buy some shares and let's sell a call maybe up here or above these price highs. So we're giving the stock room to move to the upside if it decides to go that way. But we're still going to have an obligation maybe up at 134, 135. I'm guessing it's going to have to be 135. Let's go have a look at the trade tab. And as we move out, yep, we were on the 16th of May. That's good. So we could do 134 or 135. Stock's trading at about 129 bucks. Even the 135 contract will get about 1% of that. So for some traders who use what they might call the 1% rule, which is get at least 1% premium versus the purchase price of the stock, that could be offered way up here at the 135. So let's do that. Let's go to our charts. I'm going to sort of map this out on the chart so you can see this. Let me reset this. There we go. But what if we were to sell? Let me draw in a line here to help us visualize it. We're going to sell the 135 call. That's going to be right there. So if the stock does rally, if we're below 135 at expiration, most likely we just have shares that are now profitable and we've collected some premium for income. If it goes above 135, that increases the risk of assignment. If we're above 135 at expiration, it'll get assigned with very rare exceptions. But that's going to be our trade. So let's do it. So let's go to that 135 strike. I'm going to right click on the strike. It doesn't matter whether I do the bid or the ask. I'm just going to right click there and we're going to buy a covered stock. That's what Thinkorswim calls a covered call. So that's in order to buy 100 shares, and that's what we'll do here. Let's do 100 shares and then sell that 135 call. It looks like the net debit might be 127.38, maybe up to 127.43. Let's say that we're willing to spend halfway between the mid and the natural there, trying to increase the likelihood of a quick fill here. Let's click confirm and send, buying that one covered ABT 16th of May 135 call, covered call at a 127.40 limit. There's our maximum profit. There's our maximum loss. There is a commission here to be paid. And let's send that off. Okay, and we bought that for 127.36. So now I want to move into these. So we're in this trade. What are some considerations between now and expiration? What could happen with this trade? What might we want to keep an eye on? And I want to talk about this from sort of a beginner's perspective. There are some important things that a trader might want to keep in mind. But before we get into those 5 things, let me say, first of all, there is a survey out there in the chat for those that are here in the live stream audience. If you do me this favor, click on that survey link that's been added to the chat window and then fill out that survey after the webcast is over. If you've never filled out one of our surveys before, I'll just tell you, it's 2 quick multiple choice questions. Then it'll have a comments box and a suggestion box. So you can fill those out. That would be fabulous. What I will say is that if you take the time to fill that out, I always take the time to read through that data and I read through the survey comments, and it always helps. So it's never a wasted effort. All right. Thank you. And Brent, thanks for reposting that. Definitely appreciate that. But here's the scenario that we find ourselves in. If we go to our monitor tab, let's go down to our unallocated because that's where that position is right now. There's ABT. I'm going to right click on this and let's move this to our covered calls and short puts group. There we go. So there's our ABT now. So we bought 100 shares at 128.68 and we sold that 135 call for $1.32. So our preference here is for the stock price to grow. So we bought it for 128.68. You can see it's down actually about a nickel. And that's not good for that stock position. So we have a preference here for the stock to go up, but how high? Well, that 135 call, if we're new to trading options, let's just remind ourselves this deal that we've gotten ourselves into. We now have a contract for which we were paid $1.32. That's $132. Somebody out there paid us $132, but in exchange, they now have the right to buy these shares from us. These shares that we bought for 128.68, someone now has the right to buy those shares for $135. Now, if they do that, is that a terrible thing? No, we'd make a profit on the stock. We get to keep the premium. That'd be a good outcome. That would be a profitable outcome if that's the way that we're defining good. But we just have to be aware that that is our contractual obligation for as long as we're still in this contract, potentially all the way through the 16th of May. So we have now 25 days in front of us where lots of things can happen. So let's talk about that. Here we are. Stock could go up, could go down, could go sideways. That 135 represents that call that we sold. So let's map out a few things that a trader might want to keep in mind on the way to expiration. Number one is, and this is obvious to the veterans here. I know I'm stating the obvious here, but keep an eye on the stock price versus the strike price. Now, if you're a veteran of this, well, of course, Cameron, we're going to keep an eye on what's happening with the stock versus the strike price, because our stock is right now at 128.80. Ooh, that's good. It's going up from what we paid for it. Anyway, but that 135 level, that represents, let's make it red. Let's edit those properties. I typically make these red, not to indicate bad, just to indicate that we sold something, okay? When I use green when we buy something. But in any case, keeping an eye on where the stock price is versus where the strike price is can tell the trader a lot about the likelihood that they're going to have to sell their shares. So for example, if the stock price goes up and it starts to go above 135, now our trader, let's just imagine we have another party involved in this contract. Yes, there is another party, but in the world of options trading, it's not that I, Cameron, have a direct contract with Sarah out there and that we're both locked into this contract. It's not really the way it works, but to think about it that way, I think makes it easier. So in any case, we're in a contract with another party, and if the shares go above our strike price, let's say they go up to 138, 139, 140, or whatever, now the other party has the right to buy the shares for less than they're worth. And that can increase the likelihood they decide to do exactly that. So we'd call that contract at that point in the money. And an in the money contract is more likely to be assigned before expiration, even in that scenario, and this is addressing a myth that I subscribed to originally, I thought as soon as the stock gets above 135, then the other party, of course, they pounce on it. Ooh, I get to buy the shares for less than they're worth. Let me do it. The minute's at 135.01. No, they probably won't. They'll probably wait to see if the stock will go up higher, but they could. It's just that the likelihood goes up. Now, even if the stock is below 135, which is exactly where it is right now, there's still a possibility they could decide to maybe overpay for the shares. That's just less likely. Now, if the stock goes up, but not so much, that still tells us as the covered call trader here a lot about the likelihood of assignment. Unlikely to be assigned if we're below 135. But the nice thing is we're rising above the price that we paid for the stock. So assignment risk is remaining low, We're making our way toward expiration, but overall the trade is going well. Now, a third thing to keep an eye on here with the stock price versus the strike price is if the stock starts to go away from that strike price. If we're going down, well, that's reducing the risk of early assignment even further. But we're starting to take some lumps on the share ownership here. If the stock is falling in value, we're still the owners. And that what did we collect? 132? Yeah, that 132 on that option that we collected can be small consolation if our stock is really getting beaten up to the downside. So this is the first thing the trader might want to keep an eye on. Just watch that stock price versus the strike price. Now, the second thing is to really understand how time decay works, okay? So understand time decay. So what does this mean? Well, at this moment, we sold this 135 call. We collected $1.32 for that. That contract has 25 days on it. And so think of this from the perspective of the buyer of the contract that we sold this to. They just paid us $132, but they now have the right for the next 25 days. They can buy the shares for $135 at any time. They realize right now that doesn't carry any what we call intrinsic value. But a stock that can move around a lot, as Abbott Labs certainly can, it can do a lot of things in 25 days. Now, unfortunately, as time goes by for that owner of this contract, the contract conceptually can't do as much if those days are going by and the stock is sitting there doing nothing. So just imagine we're 10 days into this contract and the stock hasn't gone anywhere. Just 10 days left till expiration. There's not so much potential remaining in that contract as when it was first sold, and the contract's value will have shrunk in that case. That's due to this impact of what we call time decay. If the stock isn't moving, the value of that contract just shrinks. Now that's to the benefit of us as the covered call seller, but the combination of the days remaining till expiration plus where the price has moved from where we first placed the trade can again tell us the likelihood of being assigned, not the likelihood, it doesn't tell us the precise likelihood, just the relative likelihood of whether we're going to actually have to sell our shares or not. Okay, so if you are unfamiliar with time decay, let me make a recommendation for you. I'm going to go to our Trader Talks channel on YouTube. So if you haven't done this already, go down below the video stream right now, click on the subscribe button if you haven't subscribed to our Trader Talks channel already, because Trader Talks is where we host our previous webcasts, and I'm about to recommend one here for you that I want you to check out. But once you've subscribed to the channel, you just go to YouTube, look for Trader Talks Schwab Coaching Webcasts, and then you can find our playlists for our previous webcasts. So I'm going to go to the playlists here, and as I scroll down, we have a lot of webcast series here, a lot of information, a lot of good learning that can be had here. But I'm looking specifically, and it's a little bit further down, for trading covered calls and short puts. Okay? Oh, actually, no. I'm gonna hit the pause button on that. I'm not even gonna make you work this hard, because there's another place that I have a video that I'll recommend for you. Let's come up here, and right here, just on the second line, if you want to learn about options basics, including time decay, let's just go to this playlist. So I'm going to click on that, and I'm going to scroll right here to lesson 5, the vital role of options pricing and the Greeks, including this one Greek that's called theta. Theta starts with T, so does time decay. That's going to be your education on time decay. But really understanding the impact of time decay can be a big deal. All right. Now, third item. Whether the stock is going up or potentially even if it's going down, a trader who is in a covered call position may consider something called rolling. What is rolling? Rolling is just a fancy term that we use that means, hey, I'm going to get out of one call position and get into another call position. So for example, let's suppose that our stock is going up. It's actually doing well for the stock position that we own, but we're starting to get above that 135 level, and especially as we get closer to expiration, let's put ourselves in the shoes of this trader who maybe sees our share price rally up here to maybe 136-ish, somewhere above 135, and we're getting pretty close to expiration. That trader is now confronted with, this contract may be assigned. I might have to sell my shares at 135. Now, is that a disastrous outcome? No. If the contract is assigned and we have to sell at 135, oh well. Bought it for, what did I say, 128.68? Sold at 135. That's a profitable outcome on the stock. We also collected a premium on the option. It's a realized gain at that point. So it would be a profitable scenario. But if the trader wants to retain ownership and if that of the stock, and if that contract hasn't been assigned yet, they might consider rolling, which would mean in this case, buying back the 135 call that we previously sold into, and then maybe selling another call, possibly at a higher price so that we're not facing assignment risk quite so dramatically, or moving the contract further out in time. Adding that time element can also reduce the risk of assignment. But that's what we call rolling. Exiting one contract and then using that same order ticket to get into another contract. All right. Now, if you aren't familiar with this concept of rolling, what might you do? Well, go to our YouTube channel again. Let me just bring that up here. And just type in the word rolling. And you'll find all sorts of discussions of rolling strategies. This is the one that I would recommend to you. Automating covered call rolling orders with something called the strategy roller. But that's a third potential consideration. Now, a trader might decide, let's say the stock hasn't been doing much. It's been going mostly sideways. The shares are doing okay, but the contract has really sort of decayed down to not much value. So there's not much profit potential in that contract anymore. Well, maybe at that point, the trader might consider closing out the current contract and selling a new one, probably out at a further date, probably at maybe even the same strike price, possibly even a lower strike price. But in any case, rolling that contract out to bring in more premium and to sort of restart the potential for profit from income. All right. Looks like the little side conversation. I was looking to see if there are any unaddressed questions. It doesn't look like there are. Number 4, monitor the trade for broken support. Rather than the trade, let's call this the chart. Monitor the chart for broken support. What does this mean? Well, when we're in a covered call, would you call this a bullish trade or a bearish trade? Actually, net, it is definitely a bullish trade because it involves stock ownership plus a call. The stock position is the driver of this position. If the stock collapses, we're the owners. We're taking the lumps on that minus the little bit of premium that we collected that might help us as a little bit of buffer against that downside risk. If the stock runs up, well, the opposite is sort of the case. We can benefit from that rise in stock value up to our strike price. Plus our premium establishes the maximum that this trade can make. But here's the concept. Let me just remove this drawing. Let me remove this drawing. And let's make this one worse. Let's say our stock shares really start collapsing in value and they go down here to 120 bucks. Hey, we paid $138.68 for those, no, $128.68 for those shares. Those shares are getting pounded all for the sake of getting $1.32 of income potential. Yeah, for some traders, since this is a bullish net position, if the chart starts to send signals that the stock is really behaving more bearishly than the trader might have hoped, they might decide to just wrap up that trade, exit the whole thing, just take whatever losses they've incurred at that point. Mark says covered calls are bullish factually and emotionally. Yep, exactly right, Mark. Okay, number 5 is this provides context for all of the rest of these things that we're monitoring. And that is to align each of these decisions with the goals of the trade. What was the purpose of this trade in the first place? And you might think, well, it's a covered call. Isn't it obviously just an income strategy? Well, yeah, sometimes it's defined primarily as an income strategy. And if income is the objective, let's say that the stock is going up and we're facing maybe getting called out. Is that okay? Well, that objective has been accomplished. It isn't unique to this stock or at this time. So maybe we just get called out, we realize our income plus some capital appreciation, we move on to the next income potential. But what if we sold the covered call initially because we thought the stock was maybe likely to go down a bit? Some traders use this as a little bit of a buffer. But then the stock starts to rally and we realize, oh no, we didn't need this buffer. And now we're losing the potential for upside on the stock. In that case, that could reframe the decisions that are being made here using the other 4 things that we're keeping an eye on. And we may decide to treat this differently. We need to get rid of that buffer and let the stock run. And in that case, we might have to pay a little extra money to buy back that call. The buffer is no longer needed, and we let the stock do what it does from there. Now, a final motivation is that sometimes a trader actually wants to sell the stock, and they just sold the call to try to get that stock sold. They entered into a contract that obligates them to sell the shares, and that's what they wanted. So if the stock is going up and it looks like they're going to sell the call, great, or sell the stock, fine. But just be aware that the goals for the trade can offer context for each of these other observations. Okay, so make sure that we're defining our goals for our trade right up front. But guys, with that, we've actually accomplished what I set out to do today. I wanted to take a look at existing positions, take a peek at what's going on with the markets, but spend the bulk of our time discussing 5 things to watch as a trade moves toward expiration. Hope that was helpful. Guys, this is what we do on Mondays. We talk through planning, placing, and managing covered calls and short put positions. I hope that you'll join me again next Monday. I'll probably do a short put next Monday. Well, actually, no, I'm not, because I'm actually going to be on vacation, so someone else will. But there is an opportunity here for you to give me some feedback via a short survey. So make sure you take advantage of that. Make sure that you're subscribed to our channel, as I've already recommended a couple of times. And make sure that you're following Brent and me on X. You can follow Brent on X at Brent Moore CS. You can follow me on X at Cameron May CS. There's my X handle. Brent and I have been releasing little videos. You might want to check these out. I actually just released a pretty cool little video going through a function on Thinkorswim known as floating PL. It actually automatically calculates profits and losses trailing cumulatively on technical signals. Kind of a cool little tool. You might not be familiar with. You can see that on my most recent post on X. But in any case, everybody, I'm going to set you loose. Thanks for filling out that survey. Thank you to everybody. We have 150 people watching live. I can see 45 have already clicked that thumbs up. That's very much appreciated. Make sure that you have the habit of clicking the like button if you're enjoying the webcasts. It's a pat on the back to the presenter. It also gives my webcasts a boost in the YouTube algorithm. It helps more people find these webcasts on YouTube. So everybody, go enjoy the rest of our webcast for the rest of the day. I will see you in tomorrow's webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.